Hello and welcome back to another video on current liabilities. This time we're going to look at notes payable and calculating interest on notes payable. So let me start with a quick screen share and work with an example. Here we have C.S. Lewis Company that has the following transactions involving notes payable. They've given us 4 transactions and 1 year-end adjusting entry that needs to be made. So let's start with the first transaction. On July 1st, 2022, we borrowed $50,000 from First National Bank by signing a 9-month 8% note. So let's start first with our journal entry. So on July 1st, the journal entry is fairly straightforward. I borrowed money, so cash debit. The amount is $50,000. This money has to be repaid, and I'm going to credit notes payable. Since I have more than one note payable, I'm going to identify it as note payable number 1. The terms of these notes are 9 months, 8%. So I have this note for a total of 9 months, which means at the end of 9 months, I need to return this money, the $50,000, plus I need to pay 8% interest. Now, something to keep in mind is the 8% interest is per annum. I'm not going to pay the full 8% for 12 months because I have the note only for 9 months. I paid only for the relevant 9 months. So let me start out with one calculation over here for you. I have $50,000. The interest rate is 8%. If I had it for a full 12 months, which I don't, I'm just writing this down, the interest would have been $4,000, which is 50,000 times 8% times 12 over 12, which is for the full year. I'm going to have it only for 9 months. So let me do the calculation for 9 months. 50,000, 8% for 9 months. It's going to be the same number that you had over here, but it's going to be multiplied by 9 over 12. So it's for 3/4 of the year that I have. So the interest is 3,000. That's the total interest I will pay. Okay, so let's hang on to that thought there for a minute and then come down to the next transaction. On November 1st, 2022, we borrowed another $60,000, this time from Leon County State Bank, and we signed a 3-month 6% note. So the journal entry is going to look very similar to the previous one. Cash debit, notes payable number 2 credit. The terms are 3-month 6%. The amount I borrowed over here is $60,000. Once again, the $60,000 that I borrowed, the interest rate is 6%, but that's if I have it for a full 12 months. I would have paid $3,600, but I have it only for a 3-month period. So the 60,000, 6% for 3 months is going to be $900. That's if the full 3 months. Okay. Now, I'm going to do a journal entry on December 31st, 2022, because that's my year end. So what I do at this point of time is I just accrue the interest that I owe on these 2 notes. I'm not writing off the check on December 31st. I'm just doing the accrual entry so that I can show the expense for the relevant period. Okay, so for the year 2022, I'm going to do this journal entry twice, one for each note separately. A company would typically combine it and do it as one journal entry, but we're going to do it as 2 entries so we can see how this interest is accumulating. So it's going to be interest expense debit and interest payable, and I'm going to write number 1 to correspond with note number 1. Okay, this was if I had it for 9 months. I said it was $3,000. I have it only for how many months? July 1st through December 31st is 6 full months. So I need to do the calculation for 6 months. So when I do the calculation for 6 months, you're going to see it's only $2,000. So if it was 12 months, it's $4,000. I had the note from July 1st through December 31st for 6 months. So I'm going to accrue $2,000 of interest right now. So in my books, interest expenses goes into my current year's income statement is $2,000. I'm not paying the money right now. I'm just accruing it, and I'm saying interest payable of $2,000. This is also a current liability along with the notes because it's due within the next 1 year. Now I do the exact same thing for my second note, note number 2. I'm going to do the same type of calculation, and I'm going to say, okay, $60,000 if I kept the amount for the full, borrowed it for the full 12 months, it was $3,600. For 3 months, it was $900, basically $300 a month. How many months did I have it for? I didn't put the date here, I'm sorry. November 1st, 2022. November 1st through December 31st is 2 full months. So I need to do the accrual only for 2 months. So it's $600. So this journal entry is going to be for $600 for 2 months. Okay, so could I have done this by way of a formula? Absolutely, I could have done this as a formula, and I'll show you how the formula looks. Let me bring that over here. Drag it out over here. Easier said than done, dragging these things out there. This one is easier. Okay, so without going through all these calculations, if I had to just say, what's the amount I'd put in over here? For this, it's the first note, it's 50,000 times 6 over 12. Once again, the only thing I needed to calculate was how many months I had the note from July 1st to December 31st to 6. So 6 over 12 for 8%, you would get that $2,000. Similarly, 60,000 times 3 over 12 times 6%. Sorry, this should be 2 over 12. We had it for 2 months, not 3 months. Okay, 2 months. And that would give me my calculation over here. Okay, so now I know how much money I owe at the end of 2022. That is basically saying, if on this day I chose to repay my notes, I'd have to pay $2,000 and $600 in interest towards these notes. But I'm not going to repay it now. I'm going to pay it on the due date. Okay, so what are the due dates? Feb 1st, 2023. I repay the principal and interest to Leon County State Bank. Okay, so that's note number 2. Remember, that was a 3-month note. I already had it for 2 months. Now on Feb 1st, I'm repaying that amount. When I repay the amount, what I want to do first is I want to accrue the interest on that note for the remaining 1 month. So I basically do this journal entry for 1 month. Interest expense debit, interest payable credit on note number 2, because this is the second note. We have 1 more month, so that's $300 that I need to accrue. Okay, now that I have this in place, I'm ready to pay my note. So let me highlight these notes here so we can see which ones we're talking about. I'm going to put that in yellow. Note number 2, $60,000. Interest payable on note number 2 was $600. I accrued another $300 of interest. So what's the total amount I owe right now? I owe interest on the note, $600 and $300. So that's a total of $900. The note payable itself, what was that amount? That was $60,000. So how much cash am I going to pay right now? $60,900. So at this point of time, note number 2 is completely taken care of. Both the interest and the note itself has been paid off. Now let's come to the second note, the first note, which is on April 1st, 2023. We repay the principal and interest to First National Bank, and that was for that first note that we had. Again, what we will do at this point of time is, I will first do the accrual entry for the interest, and I will have interest expense debit, interest payable credit. Now this is for note 1. Of the total $3,000, $2,000 was already accrued, so the remaining $1,000 needs to be accrued now. That's the remaining interest. And then I'm ready to pay off the note. Okay, again, let's go through that. Interest payable, let's see the calculation. The interest payable, put this in a different color here for a second. Interest payable is $2,000 that was accrued at the end of 2022. And now I say interest is payable is another $1,000, giving me a total of $3,000 to be paid in interest. And that the amount is $3,000. And then this note, the principal amount was $50,000. So the note is $50,000. Oops. So the total amount I'm paying right now the cash that I'm paying is $53,000. So once again, when you pay interest on notes, you're going to pay interest per annum only on the period that you have the note. So if this was a 2-year note, the first year you have the full first year, the second year you have the full second year. This was not borrowed on January 1st, neither of these notes. It was midway through the year. The accrual is going to happen at December 31st so that my books can be updated appropriately. And the matching principle says I need to match that expense to the period in which it helped me generate revenues. So that interest has to be in 2022. That's a 2,000 and the 600 over here. When we come down to actually paying the amount, it's basically the total accrued interest that has to be paid. Once again, we don't need to go through all of these calculations, but this visually helps us understand the total interest on each of the notes, how much needs to be accrued at the end of the year, and what needs to be accrued just before repaying the note in the following year. So this was a quick example on notes payable and interest calculation.